So the next conversation you're going to hear from, we're coming back to practitioners, we're coming back to financial institutions, and we're coming back to policymakers. And we're going to hear about collaboration between industry and the regulators, the OCC in particular, as they are working together to really think about how do we leverage data, and data that are more representative and more complex analytics. And so without further ado, I'd like to welcome on board Gravetta Gardner. I'm not even going to try to do it. I'm going to miss everybody's name. Come on, Jay.
All right. Of course.
All right. Good afternoon, everyone. I know it's the afternoon. Y'all have to have a little bit more energy than that. Let's try it one more time. Good afternoon, everyone. All right, now you're awake. You just had coffee. You got a little sugar. Everything's good. So thank you, Melissa. My name is Gravetta Gardner. I'm the Senior Deputy Comptroller for Bank Supervision Policy at the Office of the Comptroller of the Currency. And I'm going to ask my esteemed panelists going down the road to introduce themselves to you.
Hi, I'm Jay Budzik. I'm a Senior Vice President and Director of AI and Machine Learning Model Development and Operations at Fifth Third Bank.
Thanks, Jay. My name is John Morgan. I lead product management at Capital One. I lead product for our machine learning platform, so that's where we build, deploy, and manage the models we use in the business.
I'm Rachna Singh. I head the U.S. personal banking, unsecured lending, credit risk modeling team.
Good afternoon, Mark Brucker. I'm the Chief Risk Officer for the Chase side of JP Morgan Chase.
All right. So just to give you guys a little bit of a background, Melissa's right. The OCC has used its convening authority to initiate the Roundtable for Economic Access and Change, or Project REACH, as it's more casually known. And this effort was really to bring together leaders from various aspects of the financial ecosystem. We've got the banking industry, national civil rights organizations, regulators, businesses, technology firms, all brought together to look for a solution to problems. And those problems really were barriers to access to the financial system. What we did with 4 work streams, but one in particular that tackled credit invisibles, right? Some of the founding members of that work stream, Mark and Rachna, are here with us today. But what we were able to do in this public-private partnership, there's a little bit of a twist to it, is really talk about the ability to use technology in order to solve these problems. And I think we've had some really good successes, but we really want to keep that work going. And we want to be sure that as the technology framework continues to evolve at such a rapid pace, that we're able to utilize all of this to continue to deal with these types of issues. So now with that as a backdrop, let's get started on a good conversation. And I'm going to encourage all of my panelists here, new friends and colleagues, to jump in on any question regardless of who I direct it to. Y'all promise to do that?
Yep. Yes, ma'am.
Okay, let's go. So let's start with you, Mark. So as one of those original participants in Project REACH, why do you think it's important to be part of this kind of regulator-initiated technology and data project? And do you really see the benefit for that broader financial ecosystem?
Yeah, so it's great that we're in the REACH building talking about REACH. I don't know if that was lost on everybody else as I came in.
I'm glad
look,
you said it.
yeah.
I was going to, but you know.
It's like anything that you do, you know, you've been doing this a long time and you think about all the different, maybe the parallel, if you think about like technology and people say, well, we do waterfall, now we're going to do agile. I think the biggest benefit of this was having an agile mindset to solving a tough problem. And if you think about the collaboration that took place, it was great to humanize each other and understand that generally we had the same goals and aspirations for the underserved community, bringing different lenses, bringing different knowledge base to it. but there was a trust that was built, and there was an ability to brainstorm, and just like the agile environment's intended to do, to have an idea, to share it and get immediate feedback, and to shape that idea a little bit better. And again, it all comes down to trust. So I think that piece of it was the most impactful. That common goal, that environment of trust, and the ability to have real-time conversations really accelerated the development of how we were going to tackle those things. And I think that's the biggest benefit. And certainly, when we look back on what we've accomplished there, there's times that I wish it went faster. There's times that I wish it was a little bit bigger. But we've made some really material strides, and we've got tangible things to build on. So when we said, do we want to keep going, certainly the original group, that was a resounding yes, and we've added some other folks, and we're going to start to talk about not only the data and what we did there, but also now talk about techniques and different ways to go even deeper. So it's an exciting time.
So I have to say, I think the role of the OCC in this, in addition to bringing everybody together, because we didn't create a product. We didn't create anything. We watched that evolution happen in the industry. But just because I'm curious, what did you think about the role that we played in that?
Racha, I don't know if you want to jump in. I'll start. Look, again, we're in the business of data and decisions, and there's all sorts of rules. I think back to trust and humanizing one another and having real conversations. I think Gravetta and I get along real well. We're both Wake Forest alums, so we've got that in common. So
yes.
we cheer for the Demon Deacons, for those of you who aren't familiar with small ACC schools. But I think that's part of it, and getting to know people and trusting, and the ability to give direct feedback and not feel like you're going to get in trouble. And I think Gravetta did an unbelievable job, and her staff did an unbelievable job. And when we get stuck, or if we're trying to find that right person to opine, they help facilitate getting those folks in a room with us, and it kept things moving. I think any project, friction in the project can slow it down, and if it gets too slow, it dies. And I think that was a big part of what you all did, was helped us keep moving forward and keeping that traction to get it done.
I'll take that as a compliment.
Yeah,
Thank you.
and if I may add, right, I think that just acknowledging that, and that where our inputs are needed and where we add value, and bringing us in, I think is a great initiative, right? Instead of coming and telling us how to do things,
Right.
that you may not be the experts of, I think that was something that really worked well for Project Reach. And I think at times when we said, make a phone call and yell at this person, and you did that too, I'm just kidding. But I think holding each other accountable throughout the process, I think everybody was very comfortable and very open about it. And I think we did hold each other accountable for what we had set out to do. So just wanted to add that.
Thank you, Rachna.
I'll add, just as someone who's sort of new to the cash flow underwriting side of things with Reach, that there was just so much thought put into making it practical and applicable across organizations with varying sophistication and technology, that I just, you guys did a great job to design something that everybody could use.
So the point and the hope is this continues. There are innumerable issues to be addressed, but putting the right stakeholders together, making the phone calls, holding people accountable, and having that level of transparency, I think has really been the framework and the glue that actually holds it together. And to your point, Mark, I think the trust that has been built in these work streams throughout the Project Reach organization that we continue to utilize has been remarkable, bringing the stakeholders together. But you did mention data. So let's talk about that data a little bit before we get into AI and machine learning. So I'm going to stay with you, Mark. Can you tell us about the data you use today and how it's changed in the last couple of decades? And while you're thinking about that, talk about the cash flow data and how it enables you to underwrite a customer with little or no credit history.
So maybe go back a little bit. Certainly, I think folks are familiar with credit bureaus, you know, the big three, what data is out there. I mean, I heard someone talk earlier about FICO score from 30 years ago. I didn't catch all of that. I started with, you know, underwriting judgmentally 30 years ago in the credit card industry. And I do remember, you know, when the folks from FICO came out and tried to sell that product, and candidly, it did help us in a lot of different ways. And if you look at what that product was 30 years ago versus what it is today, there's a lot more data than that original score, and they've captured a lot of it, but there's more to be there. And certainly, if you think about the risk professionals and what we do, we're trying to better segment risk. That's the primary goal. So when you hear us talk about data, and certainly we'll talk more about scores, the mission is to be more accurate. And you know, that accuracy, we'll talk about fairness and how we think about that, but that is the mission. And what we've learned over time is we've gotten so efficient with the credit bureaus, sort of that art of judgmental underwriting, certainly for smaller dollar products, which ultimately lead to bigger dollar products, kind of got lost. And we said, what other data is out there beyond the bureaus that makes sense? And I appreciate Jay's comments. We wanted to be practical. We wanted to build something that just wasn't interesting, but was usable. And so we kept going around, what is that right data? If you talk to any one of the institutions, and we had lots of institutions there, everybody had their own flavor of how they used deposit data. Right. You know, we'll talk about cash flow data. And we knew that that was the right answer. We were just trying to figure out the best way to get to it. And I think there's tons of solutions available. We try to remind people, we don't think of these as this is the solution, more of, you know, what are the solutions? And it's an and answer usually. We want to do this and this. But the data that we're using today is deposit data provided by institutions. We leverage EWS, which is FCRA compliant, and that data is moved through. And when we have a no hit, so there's no information on the credit bureau, we build a path to go get that data. Very predictive. I will tell you, there's a lot of opportunities that we've talked about in the past and we continue to work on. It's a very skinny set of data. We don't, you know, I think sometimes people, there's different products out there. You can see 1,000 attributes off of a DDA account maybe. This is 12 attributes. It's ones that are super predictive, but there's a ton of opportunity to make that even more robust. But you've got to get people excited about the product. You got to get people willing to provide it, and that's sort of the stage we're at. So that data is very powerful. There's only upside to that. And again, I think piecing together a few of the previous conversations, that's a great way for folks who maybe don't have the benefits of generational wealth or other things to at least get them into the credit system faster.
And-
You had a question around how data has changed.
Yes.
I think I'd like to, well, there's a few things I'd like to bring into the conversation. One of them is this concept of relevance that's in the regulations that oversee the way we build models and use data in decisions at companies. And I think if you look at data generally, certainly there's been an explosion in the variety and volume of data in the world at large. But I think to the point that you were making earlier, the data inside of a bank that's used in decisioning has actually, I think, stayed relatively static over a long period of time. And I think the biggest change hasn't been necessarily a growth in a variety of data, because it just might not be relevant. What might be relevant to the next ad shown to me on my Instagram feed just has no relevance, right, to somebody's long-term financial health. I think what has changed significantly in the last 10 years, 5 years, 1 year, is the technology we use to manage the data, to ensure that we have sufficient quality, sufficient volume, sufficient controls, because you know the data you use to, say, develop a decision might differ from the data you use in a decision-making environment. And so I think technology has really supercharged our ability to use data at scale responsibly. And I think that has been the biggest change with data, at least inside of the banking industry as I've seen it.
So using some of the same old data, so cash flow data has been around forever, right? But using it in a predictive way for credit underwriting, not so much.
I think it's certainly newer, right? Because
Right.
the data is just more distributed than it would be for bureaus, where you have 3 bureaus to go to, as opposed to potentially 5,000 sources of cash flow data.
So can I ask, there's this little known piece of guidance that was issued in 2019, right before we went into the pandemic. I always reference this because usually the regulators issue guidance, and then we have a chance to go around the country at all the conferences and we get to talk about it and tell everybody what it is. And it was our way of saying, you can use this data in a new and different way. Was that helpful? Because we never talked, we went into a pandemic and then kind of came out on the other side. And I'm going to selfishly want to know right now if that guidance had any impact on moving that, the use of it along, in addition to the technology that allows you to use it better.
So I'll give you John Morgan's opinion, not Capital One's opinion on that point of view. Yeah, I think it's helpful. I think to the point you were making earlier, it's about continued trust on understanding what data is relevant and useful and ensuring not only healthy customers, but a safe and sound banking system. And so I think it helped at least me think, okay, we're seeing eye to eye on the potential value here for all parties involved.
I'd agree with that. You did nail something there, though. A lot of the old institutions, were pieced together through acquisitions and other things, and those systems didn't historically talk to each other.
That's right.
So I've worked at monolines that only did lending, that didn't have any deposits, and then moving into larger institutions with both. There was a technology challenge of how do you get that data across to that business, and how do you do it in a very safe way, and how do you ensure its accuracy? So I think that's a really good point. Probably, I'd say 8-9 years ago, you really started to see that synergy come across. But I think it is a combination of demand, but also the ability to do it in a reliable way.
Okay.
And yes, it helps. I'll give it to you.
Okay.
Yeah.
It does.
And I think there's been a lot of skepticism from other supervisory agencies around the relevance of data to decisioning and sort of cautionary tales related to ensuring the data has a nexus with the credit decision. My favorite Donna Murphy quote. And so providing that regulatory clarity around a particular class of data, I think, is really helpful.
Yeah.
So building on that, let's move on, Jay, because I think we should talk about AI and ML now. So my understanding is that these products are in some ways being used in the credit decisioning process today, right? Now that may raise questions and concerns for, I was gonna say some people, but maybe more than some, all right? But what do you think we need to know about the use of AI and machine learning in credit decisioning today? What do you think that all of the members of the financial ecosystem need to understand about the use of that? Because going back to Mark's earlier point about how he got started, subjective lending. And now we have this technology and the data. So what do you think?
I mean, look, there's no question that you can build more accurate models using machine learning methods. I think that's pretty well known at this point. But that those models don't, there's no free lunch. You also have to explain to consumers why they were denied or why they were subject to an adverse action. You have to ensure that the models are fair. You have to prove that there was no disparate treatment in the models, that whatever disparate impact may exist is business justified, and that you've searched thoroughly for less discriminatory alternatives. That's very clear. And those steps were it was not obvious how to do those for machine learning models when they kind of entered onto the scene. And so I think kind of the thing that I would leave for folks to consider is that I think now we're at a point where there's been enough examples of how to implement machine learning safely. There's been some work done here at FinReg Lab in 2022 to sort of outline various approaches to doing adverse action, to ensuring the fairness of outcomes of those models, that it's sort of time to get going because they are so much more accurate and they can be so much more inclusive.
Yeah, I'll probably add something to that, which is I think machine learning proved that the apparent transparency and safety of the prior regime of econometric and regression models was really only a fantasy that could exist in a textbook. That in the real world, data is complicated, it's messy, and these models are incredibly complicated, even if you're just using logistic regression or something more traditional in that space. And so I think machine learning made the users of that technology confront that complexity, especially in a regulated environment, where the standards for performance and manufacturing quality are the same regardless of how you deliver that solution. And so I think, yes, machine learning models are more complicated, but it's certainly possible to develop the practices to manage them sufficiently, as I think many banks have shown.
So, Rachna?
So I think, I'll link this back to the data, and I would say that as the data became expansive, and we've always had data, it's just that our ability to store and retain that data and harness that data was never at the point that it is today, right? Today, you hold the compute in your phones that you used to have in a box sitting in your home 20 years back, right? And that's a fact. So I think that whole sort of, the data becoming cheaper to store and process and learn, I think gave way to machine learning. And we will go to AI later, but I think we're talking credit risk. I would want to stick to machine learning here a little bit. But I think, so then we had to think about when you bring that data, how can, in the context of traditional regression, you can learn from that data? And for those who know, traditional regression is survival of the fittest. It is not going to let you have 100 variables in the model, so you really had to then, think about new technologies, and that's where some of the ensembling methods in machine learning, tree-based algorithms, and we've always had tree-based methods, quantitative methods in our decisioning. We have used decision trees, and some of the concepts of machine learning are very similar. They're just sequential, but the underlying principle is the same. So I think that as you think about it, would you be more confident if I decision you using a model that only has 5 or 6 dimensions of variables of data elements that I looked at? Or do you think that you would be more confident if we took a holistic view of that consumer and brought in more data, and not just brought in more data, but we were also able to distinguish which data is more important for which consumer? Because that's what machine learning does. It doesn't fit a linear line through for everybody, because this concept of linearity is not true in real life. That's not how consumer behavior works. So I think it's machine learning. That's why we all probably know, but for those who are not yet convinced, it actually produces very accurate outcomes in assessing the credit worthiness of the consumer. And I think with that, it becomes very important that when something is going to be so good and accurate at doing something, that the underlying model design and the data that we are feeding to it is also very sound. So much of the risk that I think of in machine learning does not come from the algorithm. I mean, we have to stop blaming the compass for pointing north, because that's what we told it to do. And it does that pretty well. The machinery works pretty well. And I think we have enough evidence of that. What we do not have a very good framework for and a very good understanding of collectively as an industry is this is still very new. This technology is still evolving. New techniques are coming up. And our understanding of these, these techniques is where we have to be very careful, is how you selected the data, how you sampled the data, why do you think that input should be in the model? Because at the end of the day, we still have to hold ourselves accountable for what does that variable have to do, why is that information important for assessing somebody's credit worthiness? Yeah. And as long as we are developing these machine learning models, keeping all those principles in place, I don't feel very concerned, but I think that those are the risks that I would like to call out.
It might be good too, just for us, I mean, we've been on the journey, and John talked about the controls.
Yes.
And you mentioned the bulletin that came out in 19, I forget the number. The Fed and you all talked about model risk governance, and a very big push, I think around 2016. And
Oh,
just
yes.
for folks that aren't familiar with regulated institutions and what we do to make a model, the controls in the process are significant. We've got data use governance in that curation of a variable, and does it make sense, and is this intuitive, and where did we get it, and is it accurate? You have a modeling team that's building models, and what are the techniques that they are using? What's the stability of that? They've got to defend that position. They're summarizing. They're writing up the documents, and then you have a equally talented person on the other side of the wall challenging how they developed it. You then get into fair lending tests that I think Jay or John mentioned, and is there a better way to do that? How do we substitute variables? What's that trade-off equation? I mean, all of that is happening on every model we build behind the scenes. And I think we were fortunate that it didn't feel as good at the time, I will be honest, but we were fortunate to really ramp up model governance in general when we were still in a regression world. Mm-hmm. And I think that piece of it, John, you hit it, but I'm not sure everybody gets how detailed it is. And then lastly, I'd say, at least from what I've seen for our institution and others that I talk to, this journey started with, I think, marketing models and things that, yes, you want to make sure they're explainable, but, it's okay to have an understanding at a high level, but not necessarily be able to explain every individual decision like you would in an adverse action. Very predicted in fraud, and did a lot of good things in the fraud space, and that's probably the lion's share of where you would see that in the industry, and it's huge benefit for consumers and banks to weed out high-risk transactions and get those reviewed and protect everybody that's in there. And then finally, we're just putting our toe in the water on using, and I think you're right, machine learning, still, grounded in those regression, gradient boosting if you're a technologist. Like, that's where we're at today for the most part. So we feel really good, but it's been a deliberate and slow journey to get there.
And I think that's important, right? So to John's point, that I think I heard you say the phrase heavily regulated industry. That might have been what you said.
Might have slipped out.
But to that point, I appreciate the fact that for all of you, that may present some challenges in the use of machine learning and AI. Mark just focused on model risk management, but you also have adverse action explanations, fairness and bias assessments in those credit decisions, and then my best friend, third-party vendor oversight. Did I hear a oh boy or a oh yes? But those are big challenges. And while you talked about, all of the things you have built around model risk management, all of these others, the adverse actions, the fairness and bias, which I think these are the things that I meant earlier, where careful and cautious use, but it still bothers some people that you're managing that level of risk. So pick one. John, I'll start with you.
With the third-party oversight in particular?
You want to go with that one?
Sure.
I'll go with it.
Sure. I think it's tied to something I was saying earlier, which is there isn't really a difference in the oversight expectations, and the performance, and the manufacturing quality expectations of a third party than there is over something that we've built ourselves. I think that's actually been one of the most helpful aspects of the regulatory regime and model risk management that I've witnessed. Because while I lead product today, I'm a career data scientist. I became a data scientist outside the banking industry and then came into it about 12 years ago. And what I've observed is that this enforcement of standards on performance and qualities, regardless of how you get there, actually does lead to innovation. Where as long as it's enforced effectively, you'll find a way, if there's value for the company, for its customers, you'll find a way to achieve that level of quality. And so I see it as largely a matter of enforcement and oversight and having the right processes and controls to ensure that there isn't some sort of end run or arbitrage opportunity through the means of production.
Jay?
I don't know. I mean, the third-party models that, kind of broad market credit scores, I think have gotten away with a lot over the course of time compared to the models that we develop internally, or that even some custom models that are built by vendors, especially with regard to bias and fairness testing, especially with regard to the transparency on the attributes that are included. And it's sort of it's gone too long that those, the claim of proprietary nature of these models is sort of getting in the way of us being able to really inspect what's going on to ensure that we're not either putting our institutions at risk or harming consumers in the process of using those scores. So I think like the sort of statements by the director this morning related to scores are sort of long overdue. I'm really pleased to sort of hear it. I think for the custom models, like the thing that's kind of cool about having the ability to put your finger on the data and to see how the attributes interact and to apply those transparency techniques is that you really can sort of get into all of those questions about whether the variables are related to a protected group. Are the models the fairest they could be? You can apply really advanced analytic techniques to debias the models and to make them the credit products more accessible to consumers, including models that use cash flow data and other alternative data, just to sort of be safe that you're not sort of stepping into a regulatory quagmire when you go use the data or use the model. So I think that's kind of an advantage that a lot of us have who have data science teams that smaller institutions could benefit from.
Yeah, I mean, on your point on the third parties, potentially getting away, with things. I mean, I do think that the financial institutions themselves have a role to ensure that the mechanisms they use to power the products, conform to the regulations and laws. And at Capital One, we will not, I mean, machine learning and AI solutions, we don't use them until we trust them. And it takes a lot to build our trust in them. And I think that's just that's a standard that we hold. And even in the topics of things like explainability, there's many purposes for explainability, but the number one purpose for explainability is so that our credit officers can trust this to underwrite huge volumes of loans.
Right. So to that point, with this rapid technological change, do you think there's sufficient guidance when it comes to fairness and explainability? We're talking about adverse action notice requirements, all of the fair lending laws and regulations. Do you think there's enough guidance out there, or would you like to see more?
So what I would say, at least Capital One's perspective, is yes, I think the guidance is sufficient because we've been able to find a way to meet the guidance with the means that we have. I do think there's probably some room for update of terminology. It's getting pretty antiquated at this point relative to advancements that have been made in machine learning space. But I think one of the things that remains true is the principles that you need to adhere to, regardless of the technology that you're using. And so I think in that regard, we feel that the regulations are sort of sufficiently comprehensive, understandable, and achievable from a technology standpoint. But Jay, to your point, that's not necessarily a position every institution, has the benefit.
Exactly.
I think that's important. Mark?
Well, I think that's why at least that's why I raised my hand to be a part of this. To accelerate the learning, and you're right, I think different people are at different places, but enforcement and interpretation, get cleaner over time, right? And I think there's an opportunity for these institutions and key stakeholders and regulators to talk through sort of what does good look like. And I agree with you. The language, not everybody's on the same level of understanding. So I think that's a big part of what we hope to do is get that common language and that understanding. And, somebody's showing you game theory and, what's the greatest contributor to this decline, like put that in kitchen English as well, pull that through with diverse viewpoints and say, does this meet the spirit of the regulation?
How many times have you had to explain the difference between supervised and unsupervised machine learning methods, for example? It's very confusing.
Yeah. So I think that's the benefit.
But from a principles-based perspective, the principles of all the guidance, I think they give you what you need, but I will agree, that perhaps a lexicon that allowed regulatory speak to data scientists, speak to machine learning and AI would help. So that level of clarity, but guidance or regulation?
Well, so I was thinking about this in the context, and I should probably caveat that, like Capital One, like an internal sport at Capital One is coming up with analogies that are harder to understand than like the thing we're trying to convey. But I would say I kind of think about it as sort of a car safety regulation, right?
Okay.
Regardless of how a car is built, it still needs to conform to certain safety standards. And those safety standards aren't, yes, they evolve over time as we learn new ways for cars to lead to fatal accidents, but you apply those same standards regardless, to every make and model of car, regardless of how it was built, whether it was handmade, whether it was built in a factory, and so forth. And so I think just this principle of if you're measuring the right outcomes, and if you have the right foundational principles for deciding what is a sufficient level of quality, I think you land in the right place, and I feel like the guidance that we have today supports that.
You agree?
Oh yeah, I mean, I think, the model risk management guidance was written at an altitude that applies equally well for traditional and machine learning methods. It was a really great piece of work. And likewise, thank you. Same with the fair lending laws. It's very clear, right? It's just, I think, wasn't always thought possible. And so I think kind of that's what's changed, is that now it's really possible to do all that stuff.
But going back to the fairness, just for a second, you do have all of these data points, or a smaller set of variables, to your points. How do you get John Q. Public consumers to really appreciate and trust that this is not all machines, or maybe it is? Are they trusting the machine, or where is that human intervention in this part of the process where that trust can truly be built? As we continue to see all of these changes that give us grit, we've always had data, to your point, Rachna, and we've been building models. Now we have better models, but is this landing in a place where consumers can trust what those outcomes are? And how are you dealing with that?
So I think, it really, I think it goes back to the point of model governance and what your practices are. And it's not just from an oversight and second line perspective, but actually the data science team that's building the model, right? And there's a big part of how much do they understand what they're doing, how they're doing it. There's a very important skill factor here, and I would like to say that things are not running on autopilot, that we have humans and very skilled humans looking at it. So I think they're part of the entire process, right? And similar to how it has been done till date with traditional regression, the process is very much same. There are these data scientists who know how credit scores need to work, what regulations they need to comply with, who are taking it through each of the stages of that model, and as they do, they're asking themselves that question, that does this meet the requirement of the regulation, and is this in the best interest of the consumer, I think. And so I think that, really talent becomes a big focus here, because I think it's very important that as the technologies change, the individuals who are dealing with these technologies are also well equipped to build these models, which is very important. And then the whole checks and balances of model risk management, looking at it is extremely important. But as I said earlier, at the end of the day, every input needs to make sense in the context in which it's being used, and that has to happen. So that's what I would say, that we need to do, as someone who's developing a credit score, to build that trust over time, right? And I will say that, I don't want to speak for everybody here, but I think that a big part of credit risk modeling still happens to be machine learning and not AI, where we're not letting anything self-learn. Okay. Somebody has to look at what's going on, and not just that, but look at it from the perspective that it's robust, it's stable over time, and that it has the right guardrails and all that stuff is still there. The place where I think there might be some opportunities is the fairness, where I think, when we have, so traditionally you built models, you gave it a label and you gave it the data, historical data of who did not pay versus who paid. You told the model to go predict who did not pay. That model doesn't know who is who. It just knows there are only 2 classes that are given to that model. Its only job is to predict who's good and who's bad. And now when you take the output of that model and you're looking at it and you're saying bias and you're starting to see outcomes that don't seem right. That's where a very good framework is needed, because is the expectation, what is the expectation on which fairness definition is going to be more applicable in which context, and how are we going to trade off a fairness outcome with an accuracy outcome, right? These are very important topics that I don't think we have quite got a good handle on, and I think we need to keep working towards.
Yeah, I mean, I would agree with that. To just pile on a little bit, you can measure, right, whether or not somebody has paid or not. But fairness, I think it's more subjective, and I don't think there's an alignment on the right measurements to determine whether something is fair. There's obviously laws and regulations in place today for a particular definition of fairness.
Right.
But I think there's a recognition that it's maybe falling behind what consumers might expect and what these machines, AI in particular, might be able to produce.
I just add that I think the oversight and enforcement help build consumer trust for these things, right? So just to know that there's someone looking after the people that are building these things, so that watching out for me as a consumer, I think makes me trust them more. And so seeing sort of actions being taken in the public that sort of allow us to as consumers, to really understand that you are hard at work policing the banks to make sure that they are doing things by the rules, I think is helpful.
It is all about building that trust. And I do think that's a huge part of what the OCC and my fellow regulators in the federal financial space are all about. So I got one more question for you guys, though. So I'm just going to say to date, our observation at the OCC, at least, has been that the industry has adopted a pretty careful and cautious approach to the use of generative AI, okay? And everybody in this room knows that ML, AI, and generative AI are all different things. I hate to tell you how many times I hear people group them together as if it's just one big blob of technology. However, let me throw this question to all of you. How do you believe generative AI might be useful in the credit underwriting context? And while you answer that question, what do you think that the financial ecosystem as a whole needs to know and understand for this type of technology to be used responsibly by banks and fintechs?
That's a big question.
Want me to tell you again?
Look, consumer underwriting is one thing, commercial is another, right? So those loan agreements are long, and they have lots of aspects to them, and having help sort of boarding the loan, understanding the terms, looking at the notices that go back and forth, that's all, I think, great use cases for generative AI. When it comes to consumer, the risks, this hallucination risk is real. Now, no model's perfect. We have models that make mistakes all the time. Otherwise, we wouldn't have credit losses, right? And you can't sort of see the future, but you can test these things. And you can test the ones that are giving advice to consumers on your website. You can make sure that they don't go off the rails. You can put layers in front and review. You can do manual sampling, just like you do at a call center, to make sure that the call center workers are saying the right things to the consumers. You can check the AI and make sure it's saying the right thing. So in underwriting, there are probably not directly at the decision, it would be my first choice, but there's other aspects that I think could be really useful, like giving a consumer advice about what do those adverse action reasons really mean, and what could they do to change their standing, to get approved next time. I think that would be a really interesting use for generative AI. It's not directly in the underwriting process. It does deal with consumers, so there's risk, but it would be helpful. So that's a good, to me, like that's an example.
So I'll maybe add on. I'll give you kind of a cheap answer and then a slightly more thoughtful one. The cheap answer is that a limited way of thinking about generative AI is you hear about next token prediction, next word prediction, but it's not actually predicting the most likely next token. What it's actually doing is kind of randomizing amongst a distribution of possible next things what to pick. And you get this kind of creative, apparent behavior. But in the context of credit underwriting, that's basically like hooking up the machine learning models we use to make these decisions to a slot machine. And that's not something you want to do in credit underwriting.
That was scary.
Yes,
Okay.
so that's the cheap answer.
That did not instill trust
That's
at
not.
all.
It should not. You should not feel good about that at all. We know what they say about casinos. So I think a slightly more thoughtful answer is that we get a lot of the capabilities in generative AI applications from huge amounts of data, like inconceivably large amounts of data. Every time I've seen a major problem with a model that wasn't a basic design flaw or an implementation issue where something, they just didn't put the thing into the customer-facing context correctly, it was data. Most of the time, it's flaws in the data. It's hiding in millions of rows, and in the case of internet-scale data, how are you going to have the ability to sort of ferret out data quality issues effectively to use models that powerful? So I think that's still a big challenge for any sort of AI application, generative or not.
Okay.
I think a lot of indirect uses at the moment. I would say that it's going to provide a boost to productivity, and I think that's just applicable in general. The credit score and the credit decision itself, because these are not predictive models, I just don't think that they're applicable. But I think there's a lot of value in these large language models when it comes to the after the fact, the model validations. You could really benefit a lot from understanding why you took that decision. So without impacting the customer, just from that perspective, documentation, there's a lot, many use cases of LLMs that can aid the process of credit decision without really getting directly into that credit decision process.
Because now that it's an assistant, it's not taken over anytime soon. And I think, the example of feeding it, boring stuff like policies and procedures, and a phone rep is trying to help a customer. I think there's real power there because the answers that it's querying. That is the answer. This is the accurate information. It's been curated. I think there's a lot of benefit there, and we think of it as an assistant, and we think that there should always be a human in the loop. Down the road, maybe that changes. I mean, who knows what's going to happen? But I think that's the foreseeable future.
Okay. Well, look, talking to you guys this afternoon has been really great. Are you all still with me? Yeah. All right, so you woke them up. Mark, Rashna, John, Jay, thank you so much. Please help me give them a round of applause.